Hey everyone, this is Hunter Satterfield, one of the partners here at CWA, and I am joined as always by Brad Sanders, the Managing Director of Tectonic Advisors, and then one of my fellow partners here at CWA, Brian Bortz, who is also the head of our investment committee. Thanks for joining us today for our February market update. For the month of February, domestic stocks represented by the S&P 500 were down right around 0.9%. Global stocks were down right around 1.4%, with domestic bonds down as well at 1.4%. And then finally, international bonds down right around 1.9%. So obviously, we have started to see some of the market mania that we talked about last month with our January update related to GameStop and AMC and some of these things started to die down a little bit while it is sort of going on behind the scenes. The interesting thing, I think, for many of our viewers and listeners, guys, is sort of seeing the down numbers that I just presented, that everything was really down, though it's slightly down, but for 1 month, everything being down. So, Brad, you want to talk a little bit about what is sort of going on right now, both in the stock and bond market, that's sort of triggering some of that?
Yeah, I think mostly it's a continuation of some of the trends we saw in the fourth quarter. You have value outperforming growth for 2021 by just shy of 6% as of the end of March. That's what we saw in the fourth quarter. It outperformed by 5%. And while that's not necessarily a bad thing, I mean, it's stocks moving up. It does represent kind of a regime change for the overall market. Technology and the growth sectors have been the main drivers of return for several years, and they've become larger and larger parts of all the indices. So if you start to see the leadership of the market change and technology underperforming, you might see some months where you have negative returns for an index, but it doesn't mean the breadth of the market is necessarily doing that poorly. And you also have, the rates moving higher. There's a lot of anticipation. There's excuse me, inflation expectations are at a high for the last 30 years or so. And there's a lot of anticipation about the economy starting to heal and starting to heat back up now that we're getting this vaccine rolled out. And so you're starting to see rates move higher, even though the Fed's got the short end pegged. And so that's going to cause some turmoil in the stock market as well. Anytime you have the bond market kind of bucking the trend, it causes a lot of portfolio reshuffling in the pension industry, and anything that manages to a liability has to reshuffle the deck. So I just think you have a lot of those things going on behind the scenes, and it's kind of leading to an anemic market. But and that's not necessarily a bad thing. We have all the major trends we're watching are positively moving higher, and so we're in good shape, we think, as we move into the second quarter here after March.
Yeah, I think it's interesting that, Brian and I, obviously, as advisors and our other advisors here, get a lot of questions, obviously, about the things that you're talking about as far as, hey, the stimulus last year, what is the impact long term on our economy? What's the impact on our stock market? And I think one of the big takeaways that, we communicate, I think, well, is kind of talking through, in light of the things that you're talking about, Brad, with potential turmoil in different parts of the market, but continuing upward trends as well. Sort of this, diversion a little bit between value growth is just really remaining diversified. That's, I think, the key takeaway during times like this is there's going to be these pockets kind of throughout the market, and if we can stay diversified, I think that's obviously continues to be the best approach. So, Brian, also, I'd love to hear from you a little bit about some of the things that we're starting to see maybe with another potential stimulus that's coming, and as far as what we feel like the impact that may have as well upon the economy and stock market.
Yeah, thanks, Hunter. As if 6 to 7 trillion wasn't enough, it looks like there's possibly going to be another $1.9 trillion of additional stimulus that is going to be hitting our economy in the form of either stimulus checks, student loan relief, infrastructure spending, unemployment benefits, vaccine distribution money. There's a lot of money that is going to be hitting an already stimulated economy. And, as far as growth is concerned in our economy, that's going to further inflate the balloon, so to speak. I think it's going to heat up the economy, continue to drive economic growth. The long-term concern, obviously, is the Fed going to be able to manage inflation with all of this economic stimulus taking place? So there's a lot of macroeconomic things that we're thinking about for our clients. In the short term, I think you're going to see volatility, kind of like we saw the difference between January and February. I think you're going to see volatility upwards, in my opinion. I think that there's a lot of potential growth in this economy. Um, but there's a lot of things that our current administration is doing to encourage people to save more and make it easier to set up retirement plans. And then for those who have retirement plans, they're actually even talking about a second increase to the required minimum distribution age, or the RMD age. We just went from 70 and a half up to 72. Now they're talking about going from 72 to 75. And in fact, they're also talking about adding a second tier of catch-up savings for any 401k participant that's over the age of 60. So there's a lot of economic stimulus ideas that are out there. All of these are just proposed right now, but if they come to fruition, it could continue to heat an already hot economy.
Yeah, that's a great summary. Thank you. And I think as we continue to see the economy reopen, maybe, Brian, to your point, some additional stimulus, just encourage all of you as viewers to come back. Obviously, we'll be back in front of you at the end of March with the March monthly update, just to sort of see, as we start to reopen, what is the impact on both the economy and also the stock market. So thank you for joining us, and we'll see you next month.